Hey, this is Danielle. Today I'm going to be making a trade review video about Hershey's. I'm talking about Hershey's because I used this one on CNBC yesterday.
What's the trade on Hershey, Danielle?
So with Hershey's, what I'm noticing is that the implied move in the options market is about 4.5%, but this stock typically only moves around 2%. So generally with this stock, what I do is I come in and I sell the at-the-money puts and calls, buy some outer wings for protection, and just trade the vol crush overnight. I will note, however, if it trades up above $200 a share, that's where investors need to be on the lookout because that's where the trend could change in this stock.
All right, so that's the trade for Hershey and the volatile cocoa trade as well. And
Basically, we were talking about Hershey's before market open, and the main thing that I had pointed out was that the market maker expected move in the options market was 4.5% overnight. So it had a 4.5% move that was expected, but using my earnings hot zone, basically identified that this is a stock that typically moves less than 2% overnight. So, what that means is that the options premiums were pretty high compared to what the actual move usually is. And for that reason, I wanted to just come in and sell the premium. I wanted to sell the calls and the puts, buy some outer wings for protection. In this example, Hershey is actually only gapped 0.1%, which was 12 cents. And so if you come over here and look at the trade, basically what I did was I just went ahead and I sold an at the money condor, sold it at the 195 strike, and then I bought some outer wings for protection. I bought the 205s, and then I also bought the 185s. The reason why you do that is because you're trying to capture the highest implied volatility in the at the money strike before the earnings report, because those strikes are the ones that have the most premium because they're right at the money. And they're also the ones that are going to get crushed when the volatility drops off overnight. The reason why you buy the outer wings as protection is because you're going to be wrong sometimes. And maybe the stock will fly 10, 15%, and you don't want to be naked short at the money options because you have a lot of risk on the table. So by doing it this way, you're able to control your risk. And in this example, I sold this condor. It was $10 wide. I sold it for $6.48. So the max I would have to close this for if I was completely wrong would be $10. And with getting a $6.48 credit, I was basically risking about $350. So I risked about $350. And you can see I'm making $323. So it's about a 1-to-1 risk reward ratio, which is about 40% overnight. I sold it for 648. This condor is going for 325 right now. So 50% premium overnight, in and out. It was actually it was actually a little bit better even this morning. It was going for about $2.25, and I wanted to wait a little bit longer to see if I could get some more vol crush. But Hershey's ended up trading higher, so I lost about $100 waiting another hour or so. But I'm going to go ahead and close that out. That's an example of a boring trade over earnings, volatility crush, in and out on a ticker that normally moves less than the expected move. Thank you very much. Hope you enjoyed the video. Make sure you check out the links below if you want to learn where you can join me, and I'll see you in the next one.